Joining the program now is Robert Prechter, Jr. He is the founder and president of Elliott Wave International. Bob, welcome to the Peter Schiff Show.
Yeah, glad to be back on.
So, in terms of the Elliott Wave, where do we sit now? I mean, are we on the crest of the wave, or are we on wave 4, wave 5, or where is both the economy and the U.S. market?
In the shortest summary, the stock market is topping out in a bear market rally. There's so many indications I'd love to talk about to bolster that opinion. And since the stock market is topping out, really making a double top with last year, it tells me that the economy is going to follow. And so the stocks are heading south and the economy is going to follow. I think it's been a very weak bounce in the middle of an ongoing depression.
Well, to me, it might look like the economy is actually leading the stock market. It seems that the economic data was deteriorating even before the stock market figured it out.
Well, I think the stock market figured it out a year and a half ago because the New York Stock Exchange Index, which is the broad list of stocks, topped out on the 29th of April, 2011. Now, some of the blue chip stocks have brought the Dow and the S&P and the NASDAQ to nominal new highs. But the real list is down from last year, and I think finally, here in October, we're getting the blue chips to succumb. So I think the little game that they've been playing for the past few months, making new highs for the tape, is over.
Do you have a projection for the downside risk in the market before it would make an ultimate bottom?
Well, since I think most of the outstanding debt is going to be repudiated and will fail to pay off. And I think that the ocean of debt out there is sort of the monetary basis for valuing financial assets. I think financial assets are going to go a long way down, much further than most people think. And in Conquer the Crash, I said from the top, we'll see probably 90% drops in most of the indexes of stocks, real estate, and commodities. Very similar to 2932.
Now, that would be predicated then. You're talking about a repudiation of debt. So you mean...
Well, non-payment.
Yeah. So what you're
Default.
talking about is an outright honest default where the U.S. government basically levels with its creditors and says, I know that we borrowed this money, and I know you've got a bond, and we have a coupon payment, but we're not going to pay. The check's not in the mail. In fact, we can't even pay the maturity. So if you bought a bond and you loaned, and let's say you loaned the U.S. government $1 million, we're paying you zero. You're getting nothing. That's what you're forecasting?
Most of the debt out there isn't government debt. It's private debt, mortgages and IOUs and corporate debt and everything else, junk bonds, you name it. I think all of that stuff's going under. Well, I don't think the government's going to bail them out.
All right, but I
think we've seen our last $750 billion.
Right, but I'm not. My question though deals with government debt. Yeah.
Okay, well that's a segment of it. I think that'll be the last to go, and I think they're going to default one way or another.
But I'm not saying one way or another, because one way to default would be to print a bunch of money.
I know that's where you're going.
Right.
I'm saying that's not likely to happen.
So you think that the politicians are likely to be more honest and actually admit that they can't pay?
No, they're dishonest and failing. That's the difference. Let's look at something very carefully here. When did QE start? It started in the second half of 2008. If you go back to QE0, what I call QE0.
Well, I think it's
All right, they started buying assets in the Fed. They had $900 billion of assets. Now they have more than 3 times that on their balance sheet. So their balance sheet has tripled, right? Mm-hmm. Interest rates have done what from that time? They've gone from 6% to virtually zero. So according to the Fed watchers, this is the most inflationary imaginable thing. They've tripled their balance sheet. They brought interest rates from 6% to zero. I mean, markets should be going crazy. We should be in hyperinflation. And yet the New York Composite Index is selling for 70 cents on the dollar relative to its high in 2007. Before both of those things happened, commodities are selling for 70 cents on the dollar. They peaked just before the first QE started happening. Foreign currencies even haven't really made new highs from that point. The dollar's still holding up. So there's so many things that have failed to respond, not just like lately, but from the very beginning of this inflationary push from the Fed. And I think what's happening is the deflationary environment is so heavy that despite all this action, the Fed can't get these markets to new
Well,
highs.
I think that there are healthy deflationary pressures that the market is exerting to try to fix the distortions in our economy and the malinvestments. And the government is fighting against them, unfortunately. But I think it will, increase the amount of artillery that it brings to battle. Because if what you're saying is correct, and you get a wave of corporate defaults and bankruptcies, and unemployment goes much higher, right, and more people are collecting unemployment benefits, signing up for government disability, companies are failing, the government is now on the hook to bail out their pensions that have gone under, and the budget deficits are skyrocketing, more people want to collect Social Security, nobody is paying Social Security taxes, government deficits balloon.
Tax
what you're saying,
collapse.
Right, tax revenues collapse, and you're saying that even though the government has a printing press, they won't use it? They're just going to tell the voters, we ran out of money, and so you don't get your Social Security, you don't get your unemployment, we're not going to bail out your pension. I know your bank just failed. We're not going to give you any money because the FDIC is broke. Is that the scenario that you're envisioning?
First of all, the scenario you just painted is deflationary.
Yes.
But that's coming first. Now, ultimately, the government's very slow. They're always the last one to do anything. They're the ultimate crowd. They're not going to anticipate these problems. They just want to get elected next year, Mm-hmm. So it's going to blindside them so badly that they're not going to react right away. They don't have the laws in place to, quote-unquote, print money right now. They've got this whole Federal Reserve thing going on. The Federal Reserve is a bank. They're probably having very quiet discussions like, are you crazy? Do you really want to add all these mortgages to the balance sheet? Because you're going to ruin the Federal Reserve, which is a bank. So I think there are all kinds of pressures, including political ones. Like we just said a minute ago, there's not going to be another $750 billion bailout. So the only possibility is ultimately they might react and print money, but it's going to be after the bottom. You remember what happened in 1934. They passed the securities laws to prevent the crash that was already over. It had already been over for 2 years. It's not like they did it in 29 beforehand, right?
I don't think.
So they're not going to
right.
make it
So
enough.
you think they're going to be so slow to react that they're going to let, let's say, the Dow go down 90% before they decide to print a lot of money?
I don't think they have a choice. And by your scenario, they've been printing money. They tripled the balance sheet. If I said right now, if the Fed was going to triple its balance sheet today, what would happen? You'd say, oh, more hyperinflation. But they just did that, and they couldn't get any major market except gold and treasury bonds. Now, explain that one to me. Gold goes to a new high.
Well,
that's what the inflation
the explanation.
Is saying. Wait a minute. Look at gold, and within months, the Treasury bond market also goes to a new all-time high. Now, nobody looking for inflation would have predicted
Well,
that.
the explanation that I would offer is you have foreign central banks that are buying, large buyers of treasuries around the world.
But why? In a hyperinflationary scenario, that would be suicide and idiotic.
But they're doing it for political reasons. I think they're making a mistake, but they're trying to prevent their own currencies from rising against the dollar.
Well, don't you believe in markets? I mean, this is a market price. The market price.
Well,
of
the
Treasury
market
bonds
price
right now
is
like
being distorted,
yield.
right? But it's being distorted by central banks who are not buying for a market reason.
They're
buying
disagree
for
with
a
that,
political
but there
reason.
are many people who invest in Treasury bond market that must be happy
Well,
with 1.5%.
I'm not
In
finished.
fact, we
So
know that.
You got foreign central banks buying. You've got the nervousness over Europe causing money to go to the dollar that might otherwise not go there. You've got leveraged speculators, and you've got U.S. financial institutions that are getting money from the Federal Reserve and turning around and buying U.S. Treasuries with it. So you've got the Federal Reserve not only, and that's the last thing, not only is the Federal Reserve the biggest buyer of Treasuries, but it's buying even more Treasuries surreptitiously through the banking system by loaning money to the banks to turn around and buy those Treasuries. So you've got all these artificial forces holding up this market, preventing it from imploding. But one of these days, it is going to implode, and one of these days, that foreign buying is going to stop, and all the dollars that we exported are going to come rushing back, and I think the inflation is going to hit us like a ton of bricks.
You're making a prediction.
Yes.
But
you're making a prediction, too.
Don, I'm saying the past 5 years don't follow that scenario. They are totally against it. How many hyperinflations in history have bonds yielded 1%?
Well,
none of them.
Because we're not there yet.
20, 30, 40, 80%.
Well, how many?
Not 1.5. Wait a minute.
Let me ask you one question.
It's not just the Fed buying these bonds. Mm-hmm. The public is buying them. Mm-hmm. They're buying junk bonds at a record rate. The Wall Street sell-side strategists are recommending nearly 40% allocation in Treasury bonds right now. So the whole marketplace, not just the Fed and China, loves bonds.
Well,
now, if we're having crazy inflation, that doesn't make
well,
sense.
again,
And the answer
people
is
are
not.
people are still looking at the government CPI and claiming there's no inflation, even though the voters have identified inflation as their number one economic concern. Nobody seems to care what the voters are really worried about. They want to pretend they're worried about other things. But I think that what you're observing right now is a temporary situation. You're talking
I think the
about
recovery is temporary.
Well, I agree with you.
Over.
Well, I don't think we've ever had a recovery. I think the recovery is imaginary. I think it's.
I agree. It's only in nominal terms. In real terms, it hasn't really been.
But at some point, the world will wake up to that. But the difference I think you're overlooking when you look at hyperinflations of the past, none of the countries that we're talking about were the issuer of the world's reserve currency. So when you're talking about the U.S. and the dollar enjoying that position of the reserve currency, the whole world is trying to keep the dollar propped up. If America was just a normal country and we didn't have the reserve currency and we were doing exactly what we're doing, we would have already had that hyperinflation.
Look, the currency markets are the biggest markets in the world. It's a free market. People can buy whatever currency they want, reserve or not. If they were afraid of the dollar right now, they wouldn't be buying everything but. And isn't it unusual that here it is since 2008, the dollar has made a new low, despite all of this QE from the Fed, despite interest rates going down to zero, and here the dollar is not making.
Well, I could say the same thing about the euro. The euro never made a new low, despite the disaster in Europe and all the worries. The euro didn't even make a new low. That shows how weak the dollar is, that it couldn't even rally against the euro. But you're arguing that, well, markets are rational because the market perceives. Right.
My whole theme is that they're the opposite.
Well, then you're proving my point. You're saying that
I'm not.
Well, you're saying that there must not be any inflation because look at all this demand for bonds. Look,
I'm saying there's no inflation because the global bear market has been on for years. China topped in 2009.
No, but my point is
Japan in 2010.
Look, for a
Europe
while
last year.
Bob, for a while everybody
Where's
was
the
buying
inflation?
everybody was buying houses because they perceived that they can only go up. And they were wrong. People were buying subprime mortgages. Everybody wanted them, even though they were worthless. For a while, you remember there was a dot-com bubble. In the short run, you can have an irrational market that is wrong. And I think you have a bubble in the bond market, every bit as big, in fact, bigger than the real estate bubble, than the NASDAQ bubble. People are irrationally buying bonds because they perceive safety that does not exist. They don't think there's any inflation. They're wrong. But at some point, reality will come. It's kind of like a moment where, an emperor has no clothes, and the bottom will drop out of that market.
We sort of agree here because I just put out a major special report after 31 years of going up, Treasury bonds, and yields going down. We said, we think this is over. We think the era of rising interest rates is about to start. But I don't think it's because of inflation or a reaction to inflation. It's not the 70s. We can see that by looking at all these markets. It ain't the 70s. What's about to happen is the implosion of debt and the repudiation or the default on debt. And that's going to start driving rates higher because the one entity that can keep raising rates and just to keep themselves going is the government. A company can't do that and just say, okay, we'll pay you 20% or 25%. They'd be under overnight. So the government's going to do what all these governments do, whether it's Greece or Russia when it was going under. Rates will go to 20, 40, 80%, whatever, and then everybody gives up and they say, okay, we realize we can't pay.
But what is the government? In that scenario, is the government going to fire its employees or print money to pay them? Is the government going to stop sending out the Social Security checks, or is it going to print money and send them out anyway? Is the government going to default on its debt, or is it going to pay the bondholders off with the money they print?
The government's going to do whatever it takes to try to keep the people in power in power.
That means print money.
I don't think it means print money.
Well, what else can they do?
The first thing they're going to do is fail.
Is what?
The first thing they're going to do is fail on all the programs they're trying out. And, I think they're going to stop paying as much money on Medicare, and I think they're going to stop paying as much money on Social Security. They're already squeezing doctors with Medicare. Every year that comes along, they pay less in Medicare because.
But they're spending more money on Medicare. The program is more expensive.
The tax rates are going to receipts are going to fall.
I agree.
Right, we agree on that. And I think their borrowing ability is going to shrink when people start realizing now the U.S. government's in trouble. So,
I agree with that.
Forced austerity. They won't have any
choice.
choice.
I agree with that we won't be able to borrow, we won't be able to tax. But where I disagree is what the government will choose. Because once they're in that scenario, they can choose two things: slash government spending and default on their promises, or make up the difference by printing money.
My point is basically they've been doing this since 2008.
But they're going to do even more of it.
They've been borrowing like crazy. The Fed has been doing everything it could to try to create inflation, and they are failing.
No, they haven't. I mean, what prevents the Federal Reserve from just printing even more money? What prevents Congress?
Wait a minute. Now, if you'd said that 4 years ago, I'd say nothing. And here we are with the markets lower than they were in 2008. So, yeah, they printed money.
But they're going to print even more.
Sheet. That's a lot of
well,
money.
They can let it go by. They can increase it 10 times. They can increase it 100 times. I know it's not working. They'll just keep doing it because what they're going to say is we haven't done enough of it. It's not working because we've been too timid. We haven't printed enough money. You know, what's to stop the government from putting a check in the mail and sending everybody $10,000 or $100,000? What stops them?
Well, they don't have it.
But it doesn't matter. You remember the stimulus checks that Bush sent out, these little checks that came in the mail? They were $200 or $300 a piece. Add a zero. Add 2 zeros. They can send them out. It doesn't matter because the checks won't bounce as long as the Federal Reserve cashes them.
They've been sending them out.
No, they haven't. Not big. They've been sending out normal welfare checks or Social Security checks.
Look,
they can add zeros.
In my book that I wrote in 2002, Conquer the Crash, I said the Fed is going to do everything it can under its policies to create inflation, and it's going to fail. And I would say
that's the one thing they're going to succeed in. That's the one thing they can do is create inflation.
They're failing like crazy.
Well, they're inept on everything else but that. That's the one thing they can do is create inflation.
Right, but it has not overcome the deflationary pressures, and the proof of that is that so many
not
markets,
yet.
The key giant markets in the world are below their highs that were in place before any of the QEs even started.
Yeah, well, they're going to bring out the heavy artillery.
$900 billion.
I
don't think the laws are in place to let them do that. They're going to have to change the laws to let them print money.
What do you know? They were already doing it. They already ignore the laws that exist. I don't see any law that's going to stop the Fed.
I think, first of all, the electorate is already against the bailouts, so those are out of the picture. The electorate is also getting a little bit dicey about the
But
Fed.
they're not. Once they see how grave it is, they're not going to be in favor of letting it all implode. Just like they all voted for TARP, they'll all vote for printing
because of your qualifier. Once they see how grave it is.
Yeah.
They're too slow.
Yeah.
This deflation is going to be so swift and so crushing that by the time they come to and think of what they need to do, it's going to be too late.
All right, hey, Bob, it's been a very interesting discussion. We'll keep talking, I'm sure, after the break. We're coming up second hour, hour two. Don't miss it. We've got Mark Faber coming up, who might have a little bit of a different perspective. So stick around.
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on. Call in now. 855-4-SCHIFF. That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
This is Peter Schiff here at SchiffRadio.com. We still have Robert Prechter. My next guest is not coming on until about 11:15, Mark Faber. So I want to continue to talk with Bob Prechter a little bit.
I want to just change the scenario just a little bit. I think we covered our disagreement really, really well. I would like to talk for a little bit about things we agree on.
I know. You know what? That's exactly what I was going to talk about.
How about free markets versus managed economies? What do you think of that?
Free markets, obviously.
Of course.
But, the most important thing that we agree on, I agree with everything that you say about what will happen to the U.S. economy, assuming the Fed stays out of it. Assuming the Fed doesn't monetize it.
So you're right back into the disagreement again. The Fed hasn't stayed out of it, have they? They've become the most active chairman they've ever had.
Agreed.
And they're still failing.
I just think that they will up the size of the money printing, and that at some point foreign central banks will no longer cooperate with us, and we won't be able to do it. That all the money we're printing is not going to be in treasuries through the Bank of Japan or the Bank of China or the Saudis. That all that money is going to come right back to the United States, looking to buy whatever is not nailed down. But I agree that the economy, we have a credit bubble. We're over-leveraged. Everybody has borrowed too much money. Assets are mispriced. The economy is a disaster.
Corporations, governments, everybody has borrowed too much money.
Right.
And they've been doing it for 70 years.
Yes.
A lot of that has been fostered by government agencies. In fact, most of it has been. It started out with, Ginnie Mae and the Federal Home Loan Banks and Fannie Mae and Freddie Mac. Now it's student loans. They're up to $1 trillion in student loans, which is insane. They're never going to pay that back in a depression.
Of course not.
It's ridiculous. So all of this debt is just crap.
Look,
from one end to the other.
We were talking last night. We were interviewing some of the people who were working up on Bourbon Street, and we were interviewing the waitresses and the bouncers, and the majority of them were college graduates, and a lot of the people that were riding around on these bicycles. And one of them told us she had $90,000 of student loans she was trying to work off.
Good luck.
Yeah, I mean, obviously,
it's not going to happen.
The money, the debt
and I
cannot.
think they kind of knew that. I mean, the government offered them at below market rates, just as they did with mortgages all those years. And ultimately, it has to fail.
Yes, we 100%.
Full reality.
The debt cannot be repaid, and in fact, what we're doing now is just exacerbating the problem because we're simply piling on more debt. When we can't pay back the debt we have. So
there are even more derivatives now than there were at the height of the financial crisis. So we're set up for an even bigger crisis.
Agreed. But there is still two scenarios where it can pan out. We can allow the defaults and the collapse in nominal terms, or we can still have the collapse in real terms, but prevent it in nominal terms by printing enough money so that we don't see it.
Peter,
so instead of debt being defaulted on, it's just repaid with worthless money.
Peter, I know the argument. I studied it before I wrote my book. I know virtually everyone in my business is on the other side of the argument. Peter Schiff, Jim Rogers, Mark Faber, you name it. It's all they're going to print, and that's what's going to happen, hyperinflation. I think the Fed has been trying to inflate very, very aggressively for the last 5 years. They're still failing at it, and I think it's all going to be too little too late.
You think they'll give up or they'll keep trying?
I think they won't be allowed to do it. I think public opinion isn't going to allow it because public opinion is, a lot of the work I do stems from changes in mass psychology. I mean, to me, it's all about that. And what really changed in 2000, and especially after 06, 07, is a change in the way people are thinking. They're mad about the bailouts. They hate Wall Street. There's a war against credit going on right now.
Yeah.
The Fed tries to say, we're going to build up the credit, and the government's going to bail people out. Meanwhile, they're passing laws against the banks. They're tightening down and all this type of stuff. You can hardly get a loan from a bank anymore.
Yeah,
and one arm is involuntarily doing what the other arm, the opposite of what this arm wants to do. They want to inflate, but they can't help themselves. They're passing all this anti-credit law.
Yeah, but I think you're overestimating the intelligence of the American public to want to resist inflation.
Quite the opposite. No, they're just emotional. They don't know why they're.
Well,
doing
think about Greece. If Greece was not part of the euro, don't you think they would already be inflating the drachma and printing money and devaluing? That's what they would be doing if it wasn't for the discipline of the eurozone.
No, we're talking about the so-called intelligence of the public, right? Well, the public in Greece obviously is not intelligent. They're rioting in the streets as if they can recreate the money that doesn't exist and the prosperity that doesn't exist.
But Americans aren't any smarter than the Greeks.
That's my point.
So how are we going to resist the government printing money and sending everybody a check so that they can pay their mortgage, so they can get their Social Security, so they can get their Medicare, so their bank doesn't fail, so their checking account doesn't go to zero?
They're not going to be able to pull it off. The psychology of the electorate is heading toward anger. And that's not the kind of thing that
So your investment recommendation then is that people keep their money just in cash under their mattress?
I think you should hold all the gold and silver you bought in the past at decent prices, not certainly the recent peaks. And I think the main thing that's going to go up is cash.
But not cash in the bank, because your bank's going to fail and you're not going to get the money, right?
Exactly.
So you have to actually have your cash in bills under your mattress or buried in the backyard somewhere.
Yep, stored in safe places. That's right.
What about?
You're going to be able to buy stuff at 10 cents on the dollar. Right now, it's about.
Well,
70
would you
cents
rather
on the
have
dollar.
dollars or Swiss francs or yen or euros or Chinese RMB? I mean, what currency do you think ends up on top at the end of all this?
Right now, the least desired currency is the dollar. We recently, at a higher bottom in the dollar for the last several years, hit a very low reading of only 7% bulls, according to TradeFutures.com in their daily poll. The last 4 times that we've gotten into single digits, the dollar has gone up. And now it's happened at a higher low.
But that's another thing, though. So you're saying
let me
that
just
we're
add
going to
one more
default
thing.
on our debt, and that's going to make the dollar more desirable.
Yeah, what's left. See, all the dollar-denominated credit, not
Right.
all of it, but most of it, is going to implode. People are going to say, oh, I've got this nice IOU, and now it's wallpaper. So what the dollars that survive are going to be extremely valuable.
Right. So you're saying, and that would be true
In fact, they've already
they,
become more valuable. You can buy 40% more real estate now with a dollar than you could before.
well, you can buy a lot more with
You
gold
can even buy
than you
more
could
oil
before.
and commodities than you could before. You can buy more NYSE stocks than you could before. But this is just the beginning because, as you pointed out earlier, there has been inflation recently. We've been in a reflationary phase for 3.5 years. That is ending.
Right, but
though.
you are
We're
assuming-
about to head into another 2008,
But
09,
Bob,
but bigger.
you're assuming a level of government fiscal responsibility and a
No.
level of Fed monetary responsibility
No,
that's unprecedented.
It's irresponsibility that got us into the mess, and now the monster is so big they can't control it.
Well,
the monster is controlling them.
Other
The
countries,
monster-
but then how come other countries have gone through hyperinflation? How are we going to avoid the same fate
Wait.
that has hit other countries?
Greek interest rates went up to double digits. That's the black hole that's going to happen here.
But Greece can't print money. The ECB isn't allowing that. America can. That's the problem.
Yeah,
we have that supposed get-out-of-jail-free card. I think you underestimate the power of the printing press to destroy the money that you think is going to be so valuable.
I think you're overstating the power of the printing press because it's been in full gear, tripling the Fed's balance sheet for the past 5 years. It has completely failed.
Well, I think the balance sheet is going to grow a lot faster.
I know.
Hey, Bob, thanks
We'll
for
see
coming
about
by. We got a break.